Hello everybody and welcome back. In this video I want to talk about the 3 filters I use to pick every stock. Stocks that compound at 15% per year minimum. These are 3 key metrics that I've been using for almost a decade now, and most of my investments had these 3 filters, right? If you only focus on these 3 filters to filter out bad ideas, bad businesses, you increase your chances of outperforming the market. This is what I have done for almost a decade and I plan to continue. So this is what we're going to see. I will give you concrete examples of filters that you can use right away. You can use today for your future investments. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, including this year. And I plan to continue. So I'm making this video for people that want to outperform the market, video for people that want to find winning stocks. And the first element, that is maybe the most important part, is you want to invest in companies that are growing. It will be very difficult to make money in the stock market if you don't invest in growing companies. You can have some re-rating, but if you want to focus on the long term, you have to grow your revenue as a business. You don't need to grow your revenue by 20% per year, 30% per year, but you want consistent revenue growth. This is very important. I avoid flat or declining businesses. I want proof of product market fit. And I have put here 6% CAGR, which means for the past 10 years, 20 years, I want the revenue to have grown at minimum 6% per year. The CAGR here means compound annual growth rate. So I only want to focus on businesses that have grown their revenue by 6% per year. Boom, you can remove the majority of the businesses that are bad, declining, that are doing flat operations, that have been doing flat operations for many years. You can just avoid all the bad businesses, because as a long-term investor, I want to focus on growing companies that will compound earnings per share. You know, in the income statement, you have the revenue, gross profits, operating profits, net income, earnings per share. At the end of the income statement, you have this line, earnings per share. I strongly believe in the very long term, stock prices will follow earnings per share. So if your earnings per share are growing 20% per year, eventually your stock price will grow by 20% per year. Okay? And you can't have 20% earnings per share growth if your business is flat or declining, right? I have plenty of stocks in my portfolio right now. By the way, my portfolio is public. Just click the link in the description and you can have access to my portfolio on eToro. You can invest in my portfolio. So it's completely public. I'm on one of the few YouTubers that is showing full transparency. Every day you can track my portfolio, so you can check if I'm buying, selling stuff. Anyway, most of the businesses I own are growing entities, growing businesses. I have put here 6%, but for my businesses, I have more than this. 8%, 10%, 12%. If your revenue has been growing by 12% per year and you add a little bit of margins, you can reasonably have an earnings per share growth of 20%. This has been the case for some of the companies I'm buying today, right? You have Fortinet, you have MSCI, they have the ability to grow 15, 20% per year, right? And they have done so for many years now. So yeah, very important thing, only focus on growing companies. It will increase your chances of outperforming the market and generating 15% per year. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. The second element is capital allocation. I want smart capital allocators. I study management's track record. Are they reinvesting at high returns or burning cash? What I want to mean here is, what is your opportunity cost as a management team? If you generate some cash, how do you allocate this cash? Warren Buffett says the capital allocation decisions are the most important decisions a CEO can make. How is the management reinvesting in the business? Are they reinvesting everything like Mercado Libre or Amazon? Or are they issuing a dividend? Or are they doing some buybacks? They depend. Or maybe acquisitions, mergers and acquisitions, or divestitures. What are they doing with the cash? Are they repaying debt? And depending on each scenario, each business, there is a smart decision to make. For some companies, maybe the smartest thing to do is to repay the debt. For other companies, maybe the smartest thing to do is to do buybacks. And for another one, it's to do an M&A. So it depends. There is no perfect formula. And for every industry, you have trends. There are some industries, they focus on debt. There are some other industries, they focus on M&A. Some industries that are boring, car dealerships, for example, they focus on buybacks. AutoNation, Asbury, Penske. You have this industry that is focused on share buybacks heavily. Okay, you have auto parts also. AutoZone, O'Reilly Automotive, they focus on buybacks. Depending on the mindset of the management team, you know in advance if they will allocate capital the smart way. What is great is we live in the golden age of information, so you can check what the management team has said in the past. You can check what the management team has done in the past. Did they tell the truth? Did they walk the talk? Over the past 20 years, you can check the track record. Are they smart capital allocators? Did they do smart buybacks, smart dividends, smart M&A activities? It depends. And if you want to do the work, if you really want to generate 15% per year, you can do the work, check the track record, check if the management team is good or not, and you can invest accordingly. And I'm telling you, the majority of businesses are not good. The majority of the stocks are not good. The majority of the management teams are not good capital allocators. Only a handful of companies understand the beauty of capital allocation the Warren Buffett way. Only a handful of companies. Actually, you don't have that many companies that really want to allocate at the highest rate of return for its shareholders. Okay? If you find these golden opportunities, you are in a very lucky position. And I'm very lucky. I have built my whole portfolio only with smart capital allocators. And this is the reason I'm doing 25% per year, right? It's very important because if you don't do this work, this second point, you will invest in companies that are on paper good, but the capital allocation decisions are bad. So they will do more mistakes. So they will fall into more traps. So they will destroy value for their shareholders. They can do stupid acquisition, for example. They can announce beautiful synergies, and the synergies never happen. Or they can do buybacks at an extremely high valuation. A very dumb way of destroying value. No, you want to do buybacks when the stock is cheap, when the stock is low, when nobody wants to touch your stock. You are reinvesting in yourself, okay, as a company. I have a few examples for you. You have Williams-Sonoma, a retail home furniture equipment company that has been doing so wonderfully. Yeah, it's one of the best examples you can have when it comes to doubling down on buybacks when the stock is low. You have another one called Medpace. Ticker symbol is MEDP. Okay, when the stock is low and the operations are fine, instead of doing an acquisition, they just focus on smart buybacks, and they are timing their buybacks only when the stock is cheap. So yeah, it's a beautiful investment, by the way. Williams-Sonoma, I was a shareholder. I made a fortune out of this stock, and then I sold. And Medpace, I'm studying the story over there. But yeah, I'm following it. It's on my watch list. It's a great investment. Okay, if you focus on these 2 points, revenue growth, you want something that grows. And second point, smart capital allocation decisions, you remove the bad apples, right? You remove the bad companies. And you can add another layer of analysis, the EBIT margins. EBIT margins matter more than revenue. Top line growth is easy. Now that you have filtered out bad companies that are declining and flat, you want sustainability of EBIT margins. You want sustained high operating income margins. I want to see profits scaling with the revenue growth. For example, Williams-Sonoma is an example. They don't grow that much, but they focus on keeping their margins high because they want to keep their profits high. because they want to keep their earnings per share high and to do buybacks or smart of decisions. But this is not a video about Williams Sonoma, but you get my point, right? They allocate capital the shareholder way for the benefits of the shareholders, and it is what you want. So these are 3 filters, and I want to add some elements so you can add everything to your toolkit. You want to also invest in companies with a ROIC, return on invested capital, above 15%. This is non-negotiable. Now you will remove all the bad companies, right? All the companies that are not profitable, all the companies that are doing massive, stupid acquisitions with huge goodwill. Boom, you will remove everything. High ROIC means real economic value creation, not financial engineering. I am not mentioning return on equity, return on assets, return on capital employed on purpose. I'm only focusing on the ROIC. You want this to be above 15% for a decade, as long as possible. Also, you also want to avoid turnarounds, turn-on plays, or deep cyclicals. I want compounders, not lottery tickets. It's very unlikely where you will have a scenario of a turnaround play, a deep cyclical play, and over the long term, it will generate 15% per year. It's almost impossible. Normally, you know how turnaround plays work. They turn around sometimes, and then it's plus 20%, plus 30%, and then they have another problem. So they go back down. You don't want this cyclicality when it comes to stocks. You don't want to have a lot of anxiety, a lot of stress monitoring your stocks like a baby. You don't want this. You want to invest in winning companies that like their shareholders, and you can sleep well at night. This is the goal this is my investing style after all. So you shy away from turnaround plays and deep cyclical plays. I'm telling you, most turnaround plays don't turn around. It's very frustrating to invest in this category. So I only want to invest in winning compounders, not lottery tickets. And then optionality is a bonus, not the core bet. I don't rely on future narratives. Core business must already work. For all the businesses I have in my portfolio right now, they are already printing cash. They are already very profitable, growing very nicely, focusing on earnings per share, which will lead to a good stock price performance. You don't need to think too much about the future. I only want to focus on simple businesses that are already profitable, already growing, already with nice margins, already with a return on invested capital above 15%. And the last point is the skin in the game. It's always better, right, if the CEO owns 10% of the company. Insider buying is superior to fancy mission statements. Yeah, if the CEO is buying, I have an example right now with MSCI. You have the CEO that is buying in the open market. It's very bullish. So you want the management team to have a high insider ownership. They own a large percentage of the shares. And at the same time, when the stock drops, you want the CEO, CFO, CEO, like key roles, you want them to buy shares with their own money. If you add all these points, you meaningfully increase your chances of outperforming the market. So you can generate 15% per year, 20% per year, and more. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.